Okay, let's continue and look at an income statement regarding absorption costing versus variable costing. So here we have the Harvey Corporation. It has 20,000 units were sold during the year at a price of $30 each. There's no beginning inventory. Let's look at our net operating income based on absorption costing and variable costing. So we go to the next slide and we see that our variable costing contribution in the contribution format is sales of 20,000 units at $30 is $600,000. Our variable cost of goods sold is 20,000 times $10, which is variable costing only. That's 200 grand. Our variable selling administrative is 20,000 times 3 is 60 grand. So our contribution margin is 340,000. Now, if we take away from that our fixed manufacturing overhead and our selling administrative expenses of 100 and 250, then you can see that we have a net operating income of $90,000. This $90,000 is the number that represents the net income on a variable costing income statement. Let's turn that now to absorption costing. If we look at the absorption costing example, we see that sales are also $600,000, but we've included the $16 per the absorption costing of the extra $6 for the fixed manufacturing overhead per unit into the cost of goods sold. That raises it 20,000 times 16 to a total of 320,000. So we now have gross margin. Note that this isn't a contribution margin because we've included fixed expenses in it. It's not variable expenses. It's fixed expenses as well. So it is a gross margin. The gross margin is $280,000 here. That is less selling administrative expenses of 60 plus fixed selling and administrative expenses of 100 for a total of 160, which leaves $120,000 net income. So our absorption costing statement shows $120,000 of net income, yet our variable costing statement shows $90,000 worth of net income. Where's the difference? Well, we still have 5,000 units that we have built that have overhead, fixed overhead in them, in the price, in the cost, but that we haven't sold them yet. So they still sit on the balance sheet and inventory. They haven't hit the income statement yet. So until they get sold, they won't hit the income statement. And of course, that's the difference between the $20,000 or the $30,000 difference between the $120,000 in the absorption costing and the $90,000 income statement in the variable costing. So if we go past this, we can see in this next slide when you directly compare the absorption costing to the variable costing, that the cost of goods sold in the absorption costing is 120 and ending inventory has 30. Whereas in the variable costing, we have variable manufacturing costs that don't have any fixed manufacturing cost included in them, and the fixed manufacturing costs go into a period expense of $150,000. So we've taken the fixed expense and taken it out of the period costs, we've put it into the product. Some of the product got sold, which got written off out of the income statement, and some of it sits in inventory. So obviously our income statement is a little bit better because we haven't included all of our fixed costs. We certainly wrote checks for it. We certainly paid for it. We made our electrical payment. We made our rent payment or whatever else our fixed costs are. We paid it. The cash has gone out, but we have not yet claimed it on our income statement as an impact on profitability. So if we look at the two, we can reconcile this pretty simply. We compare the two methods. Variable costing, net income, 90,000. Our deferred units in inventory is 5,000 units. The manufacturing overhead per unit is $6 per unit that is included in those units that are in inventory. And if you add the two, of course, we get the absorption costing impact on net income. Now, this is the first year. Now these units are sitting in inventory, so guess what's going to happen the second year? Well, stay tuned and let's find out.